Hello and welcome to the BIS media briefing on the annual economic report, which is published this coming Sunday at 11 a.m. CET, the 26th of June, along with the BIS annual report. Turning to the BIS annual economic report, as you're aware, we have already published the third chapter of the report on the future monetary system earlier this week. So chapters 1 and 2 will be the primary focus of this session, but we are of course available to answer any questions you have on chapter 3 as well. Today I'm joined by the General Manager of the BIS, Augustine Carstens, the Deputy General Manager, Luis Pereira, Head of the Monetary and Economic Department, Claudio Borio, and Economic Advisor and Head of the BIS Research Department, Hyun Song Shin. I will now turn to the General Manager to give some opening remarks. Augustine.
Well, good afternoon, good morning, good evening to all of you. It's a pleasure to have the opportunity to address you, to present you the main messages or the main contribution of our annual economic report. Certainly, it's at least I certainly believe it's a very rich document. More than anything, also because it has been quite an eventful year. There has been two main external forces shaping the world economy, namely the COVID pandemic and the war in Ukraine. As you well know, the COVID pandemic at least has been with us for quite some time. But what has materialized itself, or what has it has manifested itself during the last year, is that we have seen a strong rebound from the initial sharp fall in activity due to the pandemic. At the same time, we saw an important rotation in consumption from services to goods. This was the strong rebound, and part of the rotation certainly has been associated with the significant monetary and fiscal support. And together with the complications, the distortions of markets that resulted from COVID, we started to see some bottlenecks. At the same time, some of these aspects, in particular the ones associated with bottlenecks and distortions in global supply chains, were re-emphasized by the war in the Ukraine. That has been also compounded by a very sharp increase in some commodity prices, more uncertainty in many respects, and we have seen a stronger tendency towards the globalization. The result of all of this is that inflation definitely flared up substantially during the last year that is covered in our report. So inflation is at multi-year high in many countries. This has been quite a very salient feature for this year, and certainly has put central banks on the spot. I would like to start by saying that this flare-up in inflation was very difficult to anticipate, and I think it has a lot of value to analyze this event in the light of the context in which things have been evolving during the last year. There has been many important surprises that I think would be very difficult to anticipate, starting with COVID and the war themselves. But it is important also to bring to the fore where are we coming from. If we can go back for a couple of years, and we were in a context where inflation was stubbornly low. Central banks were trying to increase inflation. We were in an environment where one of the buzzwords was low for long in terms of interest rates. So that was the context before COVID. Then we had COVID, and that started with the expectation of a protracted slowdown in economic activity. Sometimes it was even contemplated the possibility of a recession. Then, of course, that triggered a very important policy response. Once we start seeing the recovery, there has been a lot of prudence by central banks in terms to not initially at least abort the ongoing recovery. At the same time, in central banking, we're quite used to see relative price changes. These tend to be transitory, but in this case, they have been transitory and at the same time persistent, given the sequence of shocks that we have been receiving. Thus, what we have seen is, again, important developments in inflation, not only a flare-up in it, but also, I would say, a potential change in the dynamics of inflation. One of the analytical contributions we make in the chapter first is that to some extent the equilibrium in inflation has been perturbed. Traditionally, when you are in a low inflation regime, relative price changes really are relative. They don't really affect the overall level of the overall price level, and the markets tend to stabilize themselves. So in a way, in a low inflation regime, inflation is self-stabilizing. Now, we made the point that there is evidence, and when you move into a high inflation regime, the high inflation is reinforcing, and in particular, inflation is reinforcing as you move into the high inflation regime. So in the transition, things seem to be self-feeding themselves, and that represents a very important challenge for central banks. And I will say a little bit more about this in a few minutes. But just to put the whole picture together, we also have seen other unprecedented combinations. Traditionally, a high inflation was created by a substantial excess of aggregate demand over supply, and therefore central banks tended to tighten monetary policy, and this would generate a slowdown in economic activity. That was, I would say, in the 70s. But in the years from the 70s to pretty much 2 or 3 years ago, basically high asset prices, over-indebtedness, and financial stability issues would trigger basically the slowdown in economic activity without really having inflation present. So we have now those two, I would say, stylized events in the past on how inflation would present themselves simultaneously. So this makes the issue far more difficult to address than in the past. Associated with this, I would have to say that emerging markets probably are a little bit more vulnerable given the size of their debt, given also the resiliency of their GDP in many cases, without having fully conquered the key aspects of COVID. So this brings a heavy burden on monetary policy. We believe that the central banks need to act in a decisive way, in a timely way, and basically to prevent the full transition to a higher inflation regime. Now, this comes with the important issues. Important issues are associated with this. What would be the key, or what would be desirable, would be to really prevent this transition to a high inflation regime, and at the same time having what has been traditionally called as a soft landing. So basically, this would imply that, yes, economic activity would suffer, but would not put us into a recessionary environment. We analyze the different elements that could be associated with a soft versus a hard landing. It seems to be a tight road. The possibility certainly exists. A lot of it will depend on how transitory the shocks are, and an important additional element how interlinked are financial sector developments and the real sector. Definitely, it would be more desirable if we can have a soft landing, because that would mean that the tightening of monetary policy could be more subdued. But even if this is not the case, definitely the priority should be to combat inflation. A very important reflection we make in Chapter 1 is that we see that both fiscal and monetary policy pretty much have depleted their capacity to stabilize the business cycle. Both policies have gone all the way. We're in a situation where we have a high corporate and sovereign debt. That will introduce some frictions with monetary policy. And at the same time, monetary policy doesn't have much space given the inflationary pressures. Therefore, as we move forward, more than anything, thinking into the medium and long term, it's very important that we try to address with a more urgent eye how can we induce growth in a way without depending on fiscal and monetary policy, and therefore we reiterate our call for important structural reforms. How can we get growth going without depending on fiscal and monetary policy? Another very important chapter, Chapter 2, is basically, we call it looking inflation under the hood. Basically, in this chapter, what we do is that we look into granular data and looking in a far more careful way how relative price changes can be morphing into can basically spread and generate spillovers into the rest of the goods and prices of goods and services, and how in combination of an accommodative monetary policy, this can induce precisely a transition from a low to a higher inflation regime. We go into very granular analysis, and I would say that the three insights that we obtain from the main insights that we obtain from this chapter is that the low inflationary environment is very different from a high inflationary environment, precisely because you move from a situation where inflation is self-stabilizing to one that it could be self-reinforcing. So precisely the fact that it could be self-reinforcing, this calls for opportune and determined action by the central banks. And precisely with respect to monetary policy, this means that a priority is to prevent this transition to be completed and for a high inflation to be entrenched. So I would say these are the key highlights of both chapters. Of course, there is a lot beneath these key messages, and we're more than happy to entertain your questions or comments. Thank you very much.
Thank you, Augustine. And turning to your questions now, you can raise your hand to ask a question. You can also type it into the chat. And if anyone is on the telephone, you can email press@bis.org with your questions. So I see a hand already raised from Tom Fairless. So Tom, please go ahead from the Wall Street Journal.
Thanks for taking my question. It was basically, do you think that, we've had a series of policy announcements in the last few days by central banks. Do you think that's enough? Do you think that the path they currently foresee is going to do the job?
Well, certainly the actions that central banks have taken have been adequate. They certainly are in line of what is needed. Many of them, if not all of them, they have given some form of forward guidance. And I would say that they will be very vigilant. They will be looking into the dynamics of inflation. Each economy has their own early indicators how inflation is progressing. And I would say at this stage, pretty much all the central banks that have acted, I don't think they have given any hint that they are done with the tightening that is required. They have all, I think what has been very important is that they have basically indicate that they are on top of the issue and that they have expressed the decisiveness to act, but their actions will be data dependent, and we still are waiting. And certainly we all will be very vigilant of what will happen in the future, but at this stage, I think it's too early to say that the task has been completed.
Thanks, Tom. Just keeping an eye now for other raised hands or questions. I see Daniel Hinge from Central Banking. Daniel, do you want to ask your question?
Yeah. Can you speak a bit more to the risk of the potential risk, I guess, of over tightening by central banks? I take your point about the risk of switching to a high inflation regime, but you also note the risk of a hard landing creating problems in future. So yeah, is there a risk of over tightening by central banks? And then relatedly, Claudio has spoken in the past, I think, about kind of structural forces like technology and globalization holding down inflation. Are those factors still at play? Are they as strong as they were?
So I'll take the first question, and then I will ask Claudio to take care of his own words. In terms of the risk of over-tightening by central banks, I mean, I would say that there is always a risk of over-tightening, especially in these circumstances where conditions are very fluid. Things can change quite quickly. Also, I would say in the face of the fact that we still have a fair percentage of additional inflation that has been generated by transitional factors, and at some point those transitional factors will have to revert themselves. Now it's very difficult to anticipate when all of these aspects will be corrected. For example, the bottlenecks, the problems in the global value chains, some of the effects on the commodities. Now, but nevertheless, having said all this, I think what is very, very important is that if one, I would say, strong result that we have obtained from our analysis of the result of tightening cycles on the economy, that is a soft versus hard landing, it seems to be a relatively solid result, that you are more likely to be on the soft landing side if you tighten opportunely, in a timely fashion, and in a decisive fashion, because that breaks really the dynamics that fit into inflation sooner, and therefore you have more chance of getting to result as soon as possible. And that tends to reflect itself into, I would say, a more benign consequence on economic activity. Seeing in the opposite, a slow, gradual tightening most of the time can put you in the camp of a hard landing, and eventually you might be over tightening. So this is a balancing act, but even if there is a risk at this stage of over tightening, What we think it would be better at this stage is for it to be timely and decisive in the quarters to come. So, Claudio, please.
Okay, well, thank you, Agustin. Yes, indeed, in Chapter 2, we make a clear distinction between two forces that operate on inflation. One is cyclical forces, economics lag, and the other set of forces are structural. Both operate by influencing the pricing power of labor and firms, their ability to raise wages, their ability to raise prices, but at different sort of frequencies. I mean, the structural forces operate over long periods, they're very slow moving, whereas obviously cyclical forces are much more, move much faster. Now, just to put this in context, in a Phillips curve, the Phillips curve looks very much at the cyclical aspects. The level of economic activity relative to the productive capacity, or demand relative to the productive capacity of the economy. Anything which is of a structural nature is either hidden in a constant, which is time varying, or else possibly in a changing slope. Now, indeed, we have argued in the past that some of the structural forces that have been at play in the world economy over long periods have tended to be disinflationary. Clearly, globalization is one, technology is another. Another possible one is demographics. Now, if one looks forward, these sort of kind of tailwinds, at least some of them are going to be turning into headwinds. So the environment would become, from a structural perspective, less disinflationary or more inflationary than it was in the past. Globalization seems to be fraying at the edges, also because of geopolitical factors. Demographics are changing. Technology, on the other hand, is still very much with us and will keep blowing, I think, in the quote-unquote right direction. Finally, another structural factor to bear in mind is the transition to the green economy that has to take place. And now that transition, on balance, is likely to be also inflationary.
Okay, thanks very much. I can see various questions coming in, so we'll stay on the monetary policy topic first. I think the next question is from Greg Quinn in Market News. I'm just trying to find it here. Okay. And yeah, can you talk more about the well-known lag of monetary policy and what will happen with inflation over the next year? He says that rate hikes in some major economies only started recently and inflation is still rising in some countries. So can we really expect central banks to make significant progress against inflation anytime soon? Agustin.
Well, the lag between monetary policy actions and inflation is well known. I would say that precisely what is important is that the central banks show a very decisive attitude towards fighting inflation, because a key aspect in all of this is the adjustment of inflationary expectations. Those tend to adjust quicker than other variables, but that can have a very important effect in terms of influencing the pricing decisions of firms, but also wage negotiations. In all of this, what is of the essence is to prevent a wage price spiral, and as long as the economic agency, the decisiveness and determination of central banks, these dynamics can be kept under control. Yes, I think that we are in the early stages of the process, but as long as this is a sustained effort with decisiveness, I think that we will start seeing inflationary expectations first turning around and eventually have a convergence. And well, of course, as I mentioned already, all this process could be helped substantially if the exogenous prices that are affecting the dynamics of inflation today correct themselves smoothly as soon as possible. But that is certainly out of central bank's control.
Okay, thank you very much, Augustine. Ignacio Ferriza from El País has two questions. In the report, the BIS says that a repeat of the 1970s stagflation is unlikely. He's asking, would we completely rule out that scenario? And apart from that, a second question, does the BIS foresee a recession in the US and or in Europe in 2023?
Yes, in the report, we do the comparison with the 70s, mostly because that was the most recent period of relatively high inflation in advanced economy, and I would say globally. There are two key differences I would say between that period and today. One is that central banks and the toolkit of central banks institutionally are much more stronger. I think the periods of inflation moderation in the inflation targeting regime has reinforced the credibility of central banks. They are more able and I would say more committed to fight inflation relatively quickly. And the markets are also more attuned to what central banks can do. Therefore, I think that will make a difference as we move forward. And the other is that especially the energy shock has been, in this case, lower than what we experienced in the 70s, although broader set of prices or goods have been affected. But taking all this into account, we believe that there is a good opportunity for the shock this time to be different, and therefore the risk of stagflation is lower this time, although we cannot eliminate that scenario. And so do we forecast a recession in the US and Europe in 2023? At this stage, we don't feel comfortable in forecasting that. No, it is likely. I mean, again, there is a path towards doing the work without falling into a recession, but we cannot eliminate the possibility at this stage.
Thank you, Augustine. I'm turning back to those that have hands raised. Philip Inman from The Guardian, please ask your question.
Hello, good afternoon.
Hi.
I wanted to ask why you think the European Union, the Eurozone, is putting up or signalling that it's going to put up interest rates when it's quite clear that it has no impetus from a shortage of workers that is fueling wage increases. It's really just an energy shock. Do you think that it's appropriate for the Eurozone to tackle an energy shock with higher interest rates? And could I also ask a supplementary question, which is, how much do you think that Brexit is affecting the UK and the shortage of workers and rising wages?
So I'm not sure we can get into the detail of maybe some of the specifics, but maybe give a broad sense on the EU. Thanks.
Yeah, I mean, let me start with the first question. Can you lower this so I can see the screen? Yeah, okay. Well, you know, the thing is the following. In Europe, yes, we haven't seen much developments in terms of wages accelerating all in all, but there are already some signs. For example, one that we already document quite clearly in our document is that in many contracts in Spain, clauses for indexation in the past were only in 17% of the cases, and now we are above 30%. Therefore, there is a clear change there about the fear about inflation. The other is that many of the wage negotiations, contractual negotiations, will come in the months to come. Therefore, in a fair amount of sectors of the economy, we still haven't seen the potential effect of much higher inflation on wage negotiations and wage settlements. What we feel is that when inflation goes from under 2% to around 8% in many different countries, it's likely that that might have an impact in the discussions. That's why we believe that at this stage, is important for central banks to make it clear that they are following the circumstances and that they are taking precisely the steps to prevent those inflation levels to be perpetuated. No? So again, inflationary expectations to keep them under control is really of the essence. And the second.
So the second question was on Brexit effect in the UK. I don't think we specifically touch on that in the AER, just in relation to a shortage of workers and rising wages. So
yeah, let me give
Claudio. Yeah, thanks.
Okay. No, we don't do any specific analysis about the impact of Brexit on the shortage of labor in the UK, but clearly any factor that can affect the supply of labor will impact on the tightness of labor markets and therefore on wage increases. And if you look at the numbers in the UK, there has been a big contraction in the supply of labor. Now, exactly what the causes are, Brexit can be one, but we have not apportioned the reduction in supply to the various factors.
Okay, and I think Hyun would like to come in on that as well, Philip. So Hyun, please.
Yes, hi, Philip. And maybe I could also refer you to a BIS bulletin that we published, I think now, some months ago, where we looked at the behavior of the labor markets across jurisdictions. And one thing that we noted was the fact that the relationship between vacancies and unemployment, which is called the Beveridge curve, that relationship really did change quite substantially in some jurisdictions, and in particular the US, which saw a shift up in the Beveridge curve, which is to say, whereas before very high vacancies were a sign that unemployment was very low, in fact, vacancies really rose, even though unemployment was really relatively high. And the UK was also was showing some signs of that. And I think one of the things that we discuss in that bulletin, and I think Jill, we can send Philip the reference to that, is the idea of the shock, of the COVID shock, really sort of shaking the labour market, and dissolving some of the links that preserved the worker-firm relationships. And that kind of behaviour in the Beveridge curve wasn't really there for the euro area and for Japan. So I think there are some institutional features. You mentioned Brexit. We don't talk about Brexit specifically, but that would be an example of another sort of structural shock. So I would refer you to that.
Thank you very much. Staying just on the phones, I think it's Mark Jones has had his hand raised for quite some time. Mark Jones from Reuters. So if you want to ask your question,
Hi,
Mark.
yeah, can you hear me?
We can hear you, but you sound a little bit muffled. So.
Oh, okay.
That's better. Yeah.
It's it's a broad one really, and it's also about the idea of forward guidance. It seems that banks have kind of got themselves a little bit tangled in trying to provide forward guidance. In a situation like this, is forward guidance actually appropriate, or is it still something you encourage? And the second thing I also wanted to ask about is, we're seeing basically the end of negative interest rates in all of this, and maybe whether you think that was a good experiment, or is it something that should be kind of consigned to the monetary policy bin going forward?
Okay, Augustine.
Yeah, I mean, I think in forward guidance is still important. Nevertheless, there is a subtlety that needs to be kept present, and that is that guidance should be guidance. It should not necessarily imply that central banks are tightening their hands and becoming flexible. I think in this particular case, yes, they should give as much guidance as they can to markets and to society in general, but at the same time they need to preserve their flexibility to react nimbly to coming events. So that balance is what really needs to be stricken when we talk about the forward guidance in this context. I mean, I think that now going to the question of end of negative interest rates, I mean, I'm sure that many papers will be written about this, the post-mortem of negative interest rates. Should they be consigned to the monetary policy bin? At this stage, I think would be premature to say. I mean, at the same time, we have to put everything into perspective. This happened in a very, very particular time. Circumstances, I'm not absolutely sure if they will repeat themselves again. So time would tell. I don't know if Claudio, that he always looks into these historical perspectives, would have a different opinion.
No, not really. I mean, it was an exceptional time, facing exceptional circumstances, and applying particular analytical frameworks. Indeed, we will have to see what will happen in the future, but clearly, as Agustin underlined, these are tools that if you're going to contemplate using them, they would be used in exceptional circumstances.
Okay, thanks very much. I'll take another question from the phones and then go back to some of our written questions. So Mark Schroers from Borsen Zeitung. Mark, if you want to ask your question.
Yes, can you hear me?
Perfectly.
Yeah, perfect. Thanks for taking my question. I just have one question. Both the Fed and the ECB adopted new monetary policy strategies in recent years, with at the core a greater tolerance against the inflation rates above the 2% target. What role have these new strategies played probably played in underestimating the inflation dynamics in the last half year, last year?
Okay.
Well, I think my perspective is that probably not much. As I said at the outset of this presentation, of this event, there really are. We shouldn't forget that there have been unprecedented shocks in front of us recently. You know, I mean, there is COVID-19 that generated disruptions of markets. There was a very quick recovery in economic activity. It was difficult to modulate adequately the fiscal and monetary support that certainly it was needed just at the time when COVID was there. And then the shock to commodity prices as a result of the Ukrainian war is completely unprecedented. No, even in the case of Europe, I would say, as has been said before, as Philip, by example, asked before, is more subject to commodity shocks than to aggregate demand issues, as in the case of the U.S. So, I mean, I think that the frameworks give space and give indication how monetary policy should respond in case of inflation is above their target, and that is operating well. Those frameworks do not. There is no framework, I would say, that would protect any central bank from this type of exogenous shocks. So I mean, I think that, and also the policy accommodation by and large was dictated by the huge shock that was associated with COVID, which again is completely unprecedented. So I mean, I think at this stage it's difficult to assign the responsibility of where we are today to the appropriateness of the monetary policy frameworks.
Thank you, Augustine. A written question from Nathalie Olaf Ors from Agence France Presse. She has a question on stagflation. So she says, the BIS mentioned the risk in the annual report, but could you clarify what is the stance of the BIS regarding stagflation? Is the BIS warning against the risk of stagflation or weighing the risk as an outcome of the current situation without monetary policy, so as a potential consequence of monetary tightening?
I already talked a lot about this. Let's see if Claudio can articulate this in a clearer way.
Thank you.
I'm not sure I can do that, but maybe just to put it in a slightly different but fully consistent and complementary way. It depends what you mean by stagflation. Is it possible that there will be a hard landing? As Agustin said, yes. Is this heralding a period of protracted very high inflation in the context of very, very low growth? That's a different question, and I think it goes back to what you're saying. I mean, if central banks rise to the challenge, they will be bringing inflation down. And since they will be bringing inflation down, we would not be talking about a very protracted period of stagflation, but rather an episode of higher inflation, which is brought down, possibly, let me stress, possibly at the cost of a hard landing. But that's a somewhat different picture what we saw in the 70s, which was a very, very protracted period of very high inflation.
Thank you, Augustine. I think we'll turn tack now with some of the questions. So Marcus Fruhoff, who I think is from FATS, if I'm correct. Can the financial sanctions against Russia change the landscape of the global financial system? Does the BIS expect alternatives to SWIFT and the composition of foreign exchange reserves? Augustine.
Well, I mean, so far I would say that the global financial system is performing well, is based on very, very strong foundations. I would say that the presence of Russia in the global financial system is relatively small. Therefore, it's difficult to expect that the sanctions by themselves will induce a major change in the landscape of the global financial system. I would say that so far we haven't seen any major changes in the way central banks manage their international reserves. I think that the issue associated with Russia obviously had to do with them invading another country. So as long as you are not invading another country, therefore there is no reason for you to change your reserves or for you to reassess the usefulness of foreign exchange reserves. I think that the usefulness and the need to manage them adequately, particularly in these turbulent times, is of the essence, and therefore we really have not seen any major changes there, no. And in terms of SWIFT, well, yes, I mean, there have been some efforts done in Russia, in China, but at this stage, I would say that the dominance of the dollar in the global financial system, and therefore the usefulness of SWIFT is very strong and is there. And I would say that it's difficult to anticipate any major change in this respect in the years to come.
Okay, thank you very much.
Hyun,
Do you want to come in, Hyun, or? Yeah, if we can get sound. Yeah, Hyun.
Yes, I'm just Marcus, just perhaps on the SWIFT question. I mean, SWIFT is a messaging system rather than a settlement system. The basic structure of international transactions, would not be affected whether you're using SWIFT or an alternative messaging system. I think the bigger question that I think your question does, point to is the shape of globalization. How will globalization, what kind of path globalization will take? And I think it would be fair to say that both in trade and in financial flows, there is a reconsideration of the, if you like, the fragilities and the vulnerabilities that very extended supply chains, might present, and whether security issues to do with energy and with other raw materials and key components would factor into that kind of question. So that's a very much broader set of discussions. And I would say that those discussions have been really, accelerated by the experience of the COVID shock and the very overextended supply chains, which led to bottlenecks and the initial pickup in inflation. So I think there is a sort of broader context. But as I would just underline what Augustin said, that some of the fundamental principles will not really, be seeing, that big a change.
Okay, thank you very much. We have a couple of questions here from Lachlan Keller of Forecast News, and thank you for waiting, Lachlan. So I think the first question refers to your, Augustine, the speech you made, Digital Currencies and the Soul of Money. So Lachlan is asking about CBDC, and would a CBC run into the same issues facing the existing fiat system of printing more, leading to an inflationary currency, which is the first question. And then the second part, he says, advocates of Bitcoin and a decentralized monetary system argue that this is just the latest evolution to the age-old problem of moving value between and within human societies. So his question is, what lessons are there for central banks to take from DeFi and incorporate into a better instrument? So Augustine.
Well, to start with, I mean, starting with saying that as I have been explaining today, and it's clear in our analysis, certainly there has been a flare-up of inflation, but this has not been the result of a printing fringe by the central banks, no? But putting that aside, I mean, CBDC is basically, as also we have seen, it could be a technologically superior representation of money. Now, that by itself doesn't change or shouldn't necessarily change the nature of monetary policy and the reach of monetary policy. Yes, some transition channels could be affected in the margin, but all in all, the capacity of doing monetary policy would not be affected. Now, if we judge from the last 40 years, and I think that's the way central banks should be judged, with a relatively long time span, they have been extremely successful in keeping inflation under control. I mean, after 40 years, we're just seeing the spike of inflation, and I strongly believe that this will not be with us for too many years, and we certainly should see results in the coming quarters, no? And then on DeFi, I mean, I would go back to chapter 3, and here Hyun might be willing to elaborate. I would say that for the future monetary system, what is of the essence is to have strong foundations on a strong, credible unit of account that basically should be a central bank money, not central bank digital currencies per se, but central bank money. And part of that pillar should be also the institutional strength and the institutional capabilities that central bank has to influence into the financial system and bring reliability to the payment systems in terms of finality instead of liquidity provision and so on. Now, DeFi, broadly speaking, can bring a lot of value added to that, and definitely it should be part of the future monetary system. But the only difference is that we would depend far less on stable coins that oftentimes have proven to be everything else but stable, and Bitcoin, because they have very inherent problems that even threatens the application of innovations that are reflected in DeFi for the benefit and stability of the financial system. So yes, there are many issues of DeFi that we should take on board, should build on them, but at the same time, as part of this private-public partnership, the key pillars should rest on central bank money and the institutional capabilities of a central bank. The recent events, in a way, fully support this, given the instability we have seen in the crypto world. But Hyun, please.
Yes, thanks, Lachlan. We missed you at the chapter 3 briefing. So just to reinforce what Agustin said, I mean, you ask what lessons are there for central banks from DeFi. I think there are some lessons. What we say in chapter 3 is that there are some technical features that we can certainly bring on board and integrate within the current framework. This idea of the peer-to-peer exchange, peer-to-peer transfer of value, we look into that. In fact, it's actually very well established that you can use distributed ledger technology to actually move CBDCs around. And the idea is very similar to how you would do it in crypto. What you do is when you transfer a token, you establish the source, if you like, or the provenance. You can prove that the token that you're transferring was obtained through past valid transactions. Now, in crypto, you do that by posting everything on the blockchain so that all past transactions are public. But clearly, if you're using real names, privacy considerations would rule that out, and it wouldn't be appropriate for everyone to know where I get my groceries from, and no one needs to know. And so there are ways of doing this while preserving privacy. There are, if you like, techniques like zero knowledge proofs. We can use cryptography. So everything that you can do in crypto, you can do with CBDCs, except for money laundering and ransomware attacks, which I think is a good thing. But I think the major problem that we point out in the chapter is that crypto is just unsuitable as money. And we raise two issues there. One is that it's always in search of a nominal anchor. Stable coins are a very visible sign that they're always after the stable value, and they use all kinds of convoluted ways of getting this stable value. And if you like, what we say is If central bank money didn't exist, crypto would want to invent them. But the biggest issue is that crypto just doesn't scale. There isn't this feature of the virtuous circle of greater use leading to greater greater use leading to greater acceptance, which leads to greater use, and so on. There is no feedback loop of this virtuous kind. It always goes the other way, where the more popular a platform is, it just tends to congestion, opening the door to alternative platforms, which leads to fragmentation. There are 10,000 crypto coins out there. That just doesn't look like money. So for that reason, we say, this is just not money. But everything that crypto can do, CBDCs can also do, except money laundering and ransomware attacks.
And that was our final question. So thank you very much, Hyun. Thank you all of you for joining us today. And we hope that you have a good read of the report in the next couple of days. And our team here in communications are very happy to take any further queries that you might have. A reminder, the embargo lifts 11 a.m. Central European Time, Sunday the 26th of June. And thank you for joining us today. Augustine, Luis, Claudio, Hyun, also appreciate it. Thank you very much and goodbye.